My God. Welcome to a new episode of What Are Your Thoughts? There are catastrophes taking place left and right. I was almost late to the show because I don't have my regular set of keys. So I had to drive home and get my keys to my office. It was a whole thing. And then I got here and I heard that Michael's child had his leg stuck in a bicycle. Our pets' heads are falling off. It's all going sideways, but we're going to persevere, and this is going to be an amazing show. We have a lot to talk about. So I want to first and foremost say, Jay Vasquez, hair looking good, Josh. I know! It's looking pretty good, right? Let's see, who else? Kenyon LaPierre. This time it's Josh's fault, pretty much. Somebody said great CNBC speech today. Yo, I went off a little bit today. Yeah, I did.
You did a monologue?
You know why? Scott's not around, so it was Melissa Lee, and I kind of get away with a little bit more because she thinks I'm funny. Scott doesn't think I'm funny at all, so I just went, and it was like Lebenthal next to me. What the hell is he going to do, right? All right, who else is here? David Walsh, Lil Cap, Dr. Horton, what's happening? Gorilla Axe, we do respect your time, sir. Dwayne Barry is here, Part-Time Larry. JC, Jeff Silva, Eric Barros, we love you guys. Tonight's show is sponsored by our friends at Crane Shares. Would you say, Mike, Crane Shares is the preeminent vehicle to get exposure to Chinese equities, China stock market opportunity?
I would say that. I think we knew Crane Shares in its infancy, right? When Brendan went there, 2015?
Bro, Brendan was working for BlackRock, and then the next day he's like, hey, I started a new company, and it's Crane Shares.
So they've got China Thematic, China Core, they've got carbon ETFs, fixed income, global thematic. They've got it all. They've got it covered.
Chinese stocks stopped going down about 3 months ago, but a lot of people haven't updated their priors yet. They just assume there's like a continuing crash there, but it's kind of done. And the lockdown is done, and they're actually cutting interest rates. There's some stuff going on there that's very different than what's going on here, no?
Yeah, let me ask you. Has inflation peaked?
I think parts of inflation have peaked and parts haven't. But I know we have a lot of stuff to get to on this. One thing that I said today that I really believe, this is not like an earnings report where it's like, oh, the company is supposed to lose 8 cents a share, and then they come in with a loss of only 6 cents, and the stock rallies. I don't think CPI falling from 8.5% to 8% is like gonna rally the stock market. This is very different than a lot of the metrics that we follow on Wall Street, where like a little bit better than last month is like not going to do much because the overall conditions are still going to be really, really tough. Unless I'm dead wrong and we're at 2% CPI by end of year. It's hard for me to imagine how that would happen. What do you think?
Sorry, I missed some of that soliloquy. I'm listening to Kobe try and get out of the bicycle.
It really wasn't important. No, I'm just kidding. I was making the point that a little bit better than expected inflation is not like the same as a little bit better earnings loss or something. Like it's going to take much more than just one decent upside surprise in CPI to say that we've seen the worst.
Let's go to the charts. We're going to start with the Orient Timmer's chart. He's showing BCOM, which is a broad commodity index, in black. Seems to have peaked and coming in hard, but what's coming in even harder are commodity-sensitive stocks. These are your Freeports, Alcoa, Newmont, things like this. But I want to go through some commodity charts that I had John grab earlier. John, let's run through them. All right. We've got, look at lumber.
This was the most obvious. Remember we were laughing in like March, April? I was like, bro, it literally grows on trees. I mean,
I don't know what's happening with cotton.
This is so obvious.
But we've got a lot of commodities that are coming in. Cocoa, cotton's crashing, don't know why. Next chart. We've got metals. I saw something that base metals are in their deepest drawdown, our fastest bear market since 2008, something like this. Copper's crashing.
Bro, these things look like ARC stocks.
Platinum, palladium. We've got more. Next chart. Agricultural commodities. Thank God.
Yeah.
A lot of the spike into the invasion is coming off. Wheat, corn. So that's good. And we've got some less.
Because you know why? Because that truism about prices and commodities is like one of the ones that's really true. Like the best cure for high commodity prices is high commodity prices, because eventually the supply will catch up to whatever excess demand there is. Just happens to have happened really fast this summer.
We had Sal Gilberti on from Two Cream today on the podcast, and he was saying that production, we might have record production for agriculture commodities this year, right? Producers are producing. John, we got two or three more? All right. So that's the good news. This is the not so good news.
Give it a minute. This is on a lag. Okay. You know what because you know why? You know what the biggest expense is for live cattle, feeder cattle, and lean hogs?
Yeah, wheat. Or sorry,
the biggest expense is those other commodities that 6 months ago were making record highs, which then leads to less of these things, but it's on a lag. It's it's the circle of life. So
the only one that matters, the big one, is energy.
Yeah,
and
this kind of had a rough week? 5 or 6 days, right?
It's back.
So what's interesting is that this is the most expensive one to put new supply in place. Like planting a few additional hectares of soybeans is not as difficult as trying to up oil production by 1 million barrels or whatever. So I think like that's definitely a bigger difference than the other ones that we had up on screen.
I think the fire department's coming.
Stop it. This is too much. Can we get a camera down there?
Oh my God. So Kobe, he's fine.
What are they going to do? Spray him with the hose?
They have to cut the bike. His leg his ankle somehow got stuck in between the wheat, like the steer, like the pedal. He's totally fine. He's a little scared, but he's fine.
Where'd you buy this bike from? Shenzhen? Is this an import, Michael? Where do we get the bike from?
All right. So I was looking at. So the only thing to me that matters for the stock market is inflation. It's the only thing that matters
today.
Right now, there'll be something else once we get, assuming we get through this. So I made a scatter plot looking at the year-over-year change in inflation versus the S&P 500, and maybe not surprised. Chart off for a second, please. Maybe not surprisingly, there's nothing really there. It's sort of all over the place. Why? Because most of the time, inflation is noise. When inflation is between 0 and 2%, 2 and 4%, that's not driving anything, right? That's just that's just one of many.
No one really cares. Yeah.
So what I did was this. What does matter a lot? What matters a lot is the direction.
What about the severity?
I can't talk. No. I gotta go. What matters is the direction.
I think the severity is as important as the direction. Stand by. All right. Nicole's in the chat trolling us, saying this is awkward. I agree, Nicole.
Yeah, of course. It's very awkward. I apapologize.
What are we going to do about this?
All right. Here's the deal.
Hey, wait. Time out. Duncan, can we edit that last 5-minute clusterfuck and re-upload the video? No, later, I'm saying.
Yeah, we can edit on YouTube.
All right, because there should not be any record of that. Okay.
Yeah, this is behind the scenes.
All right.
Thank you, everybody who's still tuning in with us. All right. So what the data point that I found very interesting is when inflation is falling year over year. It doesn't matter if it's going from 12 to 10 or 4 to 2. Stocks average a 12% annual return. And when inflation is higher than it was the year before, it's down to 6%.
Okay. So what matters is what is inflation versus the prior year.
Correct. CPI versus the prior year.
And there's a really high correlation between good returns and falling inflation, no matter what level it's falling from.
So that's what matters. The other part that matters is there is a tipping point at which real returns go deeply negative. John, chart on. All right. So you see, again, 0 to 4, where it's all
Hold on.
good.
The left column is CPI range. So these are like inflation regimes: 4 to 6%, 6 to 8%, etc.
So 70% of the time, inflation is below 4%. Once you jump from over 4%, things start to fall.
Yeah,
Once
look
you
at
go
that.
over 6, it just gets very dicey. Then it's basically you're done.
But
Then real
look how
returns
rare
are-
that is. Only wait a minute. Hold on. Inflation is only between 8 and 10%, which is what it is now. 3% of the time. Going back how long? 100 years?
This is going back to 1950.
70 something years. Okay. So that's pretty notable, like what a rare period of time this is. And then look at year over year change for the S&P from 8 to 10%. I'm amazed it's still positive.
Yeah, but real returns suck.
Real
And
returns
again,
are
we're
shit.
looking at a small
Okay.
sample size.
Right.
All right, let's keep it going. So what did Kathy Wood say?
Where were we? Oh, she like mea culpa, the inflation call. Here, this is I guess she did CNBC. We were wrong on one thing, and that was inflation being as sustained as it has been. Well, that's like the only thing. Said Wood, founder and chief executive of ARK Investment Management, told CNBC, quote, supply chain. I can't believe it's taken more than 2 years. And Russia's invasion of Ukraine. Of course we couldn't have seen that. So inflation has been a bigger problem, but I think that it has set us up for deflation. Let's not even do the deflation call part of this. Fucking Teladoc was down 12 straight months before Russia invaded Ukraine. Am I making that up or is that true? Okay. Like, was Zoom working prior to the inflation of Ukraine or prior to China shutting down Shanghai? Not really, right? So maybe directionally things got worse than they otherwise would have if we hadn't seen these events. But like directionally, these stocks were already selling off from 100 times sales to 10 times sales. Like that was already always going to happen. So is that fair to say? Okay.
Mm-hmm.
Anyway, it's I guess a little bit of humility, like a little bit of hey, I got the inflation thing wrong. I don't know. What else would you have wanted to hear from that?
Let's
Good enough for you?
segue from this
Okay.
into the value stuff.
Okay. This is what I want to talk about. I saw Cliff Asness on CNBC the other day. He was like on the 3 o'clock hour with Sarah. Mm-hmm. And I was like, damn, he's got like some color in his cheeks. He looks like vigorous, happy, because the market is now going his way. He's got a little pep in his step. I don't know what AQR's AUM journey has been over the last 2 years.
We're gonna
I would imagine like last year was not a lot of fun. But now things are back. Some would say it's a return to normal. I would just say like things are back in the value direction. So people who are tilted that way or heavily leaning that way or long short in that direction finally have their moment. Have their, you know what we call that in the hip hop community? It's a glow up. It's a glow up.
All right, let's get
They're
into
having their
this.
glow up. All right. go
So
ahead.
the lead of value stocks over growth stocks. It's been a minute. Everybody knows, right? It's been.
Oh,
a
look,
long
clips
time.
in this article. John.
We're gonna get to it.
On screen.
Relax. We're gonna get to it. Throw up this year-to-date heat map. One of these things is not like the others.
Energy
And healthcare
and drugs.
Yeah.
Yeah, it's the only green is defense and energy.
So Dr. David Kelly and his team did this chart. I'm not saying that they ripped me off, but no, I'm only kidding. But I did something similar probably a year ago. Digital world versus real world. Remember that?
Yeah. Oh, yeah.
But there's an updated one. Holy moly, is this a chart?
So the digital world is like software and cloud computing and anything that's like bytes or bits or however you want to phrase it. And then the real world is like heavy shit, like real things. And these, to me, if you pull back this chart 30 years, there's like a push and pull that's been going on forever. Like one part of the economy has its moment and then the other part takes over. And who the hell knows when that's going to start or stop, right?
Correct. We've got let's throw up the next chart. The Russell 2000 value on top divided by Russell 2000 growth. So small value divided by small growth is basically had a major comeback back to where it was in early, 2014 or call it. Large stocks, large value versus large growth still has a ways to go.
Wait, what is this?
On top,
Russell
you've got Russell 2000 value divided by Russell 2000 growth. On the
Yeah.
bottom, it's the same chart, same ratio, but for large stocks.
Okay. So I find that to be something that, it just started. A lot of people are like in a rush to say it's running its course already, and as soon as rates come down, it's going to reverse. I'm not that sure about that. And actually, some of these quotes, hold on one sec. Here, Asness is saying, people like me, both for legal and for honesty reasons, should never use the word guarantee, and I won't. But I've never been more excited about value.
Who said that? Asness or Arnott?
Asness. And he's kind of looking at this as Arnott is saying, as we move closer, this is Rob Arnott from Research Affiliates, as we move closer to historic norms of relative valuation, I would reserve the right to moderate that view. But from current levels, I think we're going to have a stupendous decade, and most particularly a stupendous 3 to 5 years. So like these guys are not looking at this like it's something that is about to run its course in the next 6 months or the next 3 months. So I think that was probably the most noteworthy part of what was in here.
Let's throw up some of these charts. Let's take it in order. Let's look at the AQR market neutral total assets under management. So massive decline. And this is part and parcel of of the growth over value story. John, skip one chart and let's look at the zoomed in version. There we go. Great job. Look at this off the highs though. People are
equity market neutral is their strategy. That's long value, short growth,
more or less,
or short expensive stocks.
Yeah. So the rise and fall was a zoomed out version. Right. This is the zoomed in version.
Okay.
Massive inflows.
Yeah. I mean, because that's really I don't know what the performance is.
I do. John, would you please? Boom. Crushing.
So this is versus the S&P 500. Holy shit.
This is year to date. You know what?
Year to date.
It's been a minute. It's been a minute for AQR. And to Cliff's credit, he never did the asshole thing. He never blamed anybody. He never said it was time to go all in. Like he never did any of that. He just said, listen, it sucks. It hurts. It still hurts, but this is what we do.
I agree. And I think one of the most admirable things about AQR and Cliff is there are periods of time where they just know they're going to be out of favor. And they tend to, when they are, just continue with the research, continue publishing, and continuing putting out their thoughts. And they don't like all of a sudden switch things up and say to themselves or say to the public, all right, we're going to try this now. Because what is that, a fire truck? Kobe must be. Kobe must be excited.
They're playing the fire truck now. His leg is out. They literally cut the bike. Oh my God.
We're going to need a new bike. I got to check on the supply chain for you. What's this lead of value stocks over growth stocks? What's this chart? John, throw this up.
No. We did this already.
Oh, we got that?
All right. Last thing I want to talk about.
Okay.
By the way, what we're showing you is that market neutral, they have a dedicated value strategy called the equity market neutral global value strategy that I guess leads even more heavily. It's up 53% through May. So
that's
very,
wild.
Very happy for them. It's been a while. All right. I want to talk about this real quick. This is hilarious. Goldman Sachs upgraded Robinhood from neutral to sell.
No.
Wait, what?
No. To neutral from sell.
Upgrades to neutral from sell. That's what I said, no?
You said the other way around.
I'm sorry. Goldman Sachs upgrades to neutral from sell, but they lowered their price target to $9.50 from $11.50.
Yeah, because it's astrology. It doesn't have to make sense. It doesn't have to make sense. It's like I ask you what's your sign, and you tell me, and then I'm like, oh, you're like a highly sensitive person, and like it's just they
what's upgraded to neutral from sell and lowered their price target. I feel like I'm on Mars.
Yeah, no, that's what's up.
Meanwhile, ARK is still getting inflows.
Yeah,
I think they had 8 straight days recently.
Dude, ARK didn't make a new low in June.
Correct.
So a lot of things did. A lot of things did.
Got killed today.
Yes. But
did you notice that this was the week, Monday in particular, where you saw like a lot of sell side reports or notes about the bear market rally taking us to 4,100, 4,200, whatever.
Who's saying that? The technicians or like the strategists?
Strategists.
I haven't seen a lot of that.
Stocks got kneecapped today.
So let's go into this. Let's go into this Robinhood thing. Basically, what Goldman is saying, upgrading it to neutral from sell. By the way, neutral is like a milder version of sell. They're both sell, but the target goes to 950, and they're basing that on 1.5 times their Q5 through Q8 revenue forecast. I don't even know, dude. I don't even know what that's about. They're looking at revenue forecasts years out, I suppose, and working backwards to figure out why it's 19% undervalued. Basically, shares are trading at a $6.5 billion market cap. Cash is $6.2 billion. Tangible book value is $7. So you're basically looking at a stock that's trading at the value of its cash. And, of course, there's a lot of cash burn going on here.
Yes,
because for a long time they weren't even attempting to run this thing profitably. But I feel like some of that is within the company's control. I don't know that they have to still spend as much money as they were spending. It strikes me that maybe they could start to surprise to the upside if they can keep revenue. The problem is Wall Street doesn't think they can keep revenue even. Forget about expenses. This is a business that's been in decline for multiple quarters now, and might have seen the best it will ever see. And it's very hard to get people excited about troughing earnings or troughing revenue or troughing user growth. And I had a debate about that on TV yesterday. I don't see this as a good business even in the best of times.
Never was.
Now is obviously not the best of times.
So I don't have a lot to say here, but what do we do with pandemic economic data? Like, for example, let's look at non-farm payrolls.
Yeah, you have to. Everything's an asterisk. Everything from 20 to 22, 20 and 21 is an asterisk.
I think you just have to remove it. Like, look at the next chart.
It doesn't make it's irrelevant.
So the next chart, I just got rid of it.
Yeah,
I got rid of that like 6 month period.
Because it's absurd. It's not demonstrative of anything. Unless you think we're gonna have a pandemic every year, how could you possibly include that stuff in whatever you're looking at? Listen, for the rest of our lives, you're going to see economic data charts with asterisks because so many of those, like 1 month jump in unemployment, for example, was so off the charts that the New York Times had to make it the entire twofold cover just to fit the chart onto the page. You remember that? I think I saved that. So none of that stuff is ever going to be meaningful to anybody unless they're specifically studying the pandemic itself.
All right, I crowbarred a few more charts in here because this topic sucked and it was too late to change it.
Throw them up.
Michael Sembles did a post today talking about a bunch of stuff in his guide to the Eye on the Market, but he spoke about things that you want to see if you're looking for a bottom. This chart was interesting. What we're looking at here is the 10-year Treasury yield in blue, obviously. The circles are when it peaked, and the gray line is when the stock market bottomed. So, as you can see, yields don't have to do anything, but you would like to see yields stop rising and roll over before you can feel confident that we've seen a bottom in the stock market. Obviously, that hasn't happened yet. The other thing you said you want to look for is...
So stocks do not bottom as yields continue rising. There's a lag effect. So okay. All right. Well, that makes sense to me. Doesn't that make intuitive sense to you?
It does. The other thing that you want to see is, he said one of the best leading economic indicators is PMI. And you want to see that bottom. And unfortunately, not only is it not bottom, it's just only really began to roll over. So pretty early on that front. He has another chart that's very interesting, a table. We've said multiple times that the market will bottom before the economy does, right? The market will bottom before the news gets its blackest. The news will continue to get worse. Stocks will stop going down.
Yeah, stocks don't need the news flow to get better.
Right.
What they ultimately need is for people to just get so accustomed to the news being bad that they stop caring, stop paying attention.
Just apathy and just you run out of sellers.
Remember how many times we explained that concept during COVID? It's like, well, I'm going to wait to see like the amount of cases. No, that's not how it works.
Yeah.
What happens is, let me guess, more COVID? Fuck it, I'm buying. But that's how that works.
But here's the thing. He quantified it The days between from the stock market bottom to the GDP market bottom. I'm not quite sure why 2000 is conspicuously absent from this chart, but whatever. It's 116 days on average. Guess what? That's a long time. That's a long, long time.
It's a third of a year.
That is in real time. That is a long time. So if you're waiting for the dust to settle, good freaking luck. And by the way,
wait, Mike, back up. So this is the equity market bottom is in the left corner, and what we're seeing is that equities will bottom far in advance of like GDP bottoming, which we don't find out for a long time afterward anyway. Right?
Well, that's the key point. Is that you only know when GDP bottoms. Like, I don't know, when does MBR come out after? Is it, it depends.
Months.
It's all over the place. It's
months. And then they fucking revise it. Right. John, chart back on. The fourth column is interesting to me. That's the percentage return that stocks have earned back before GDP bottoms. Forget about the announcement that GDP had bottomed.
These numbers are actually smaller than I would have anticipated. I would have guessed it was closer to 40, 60%.
I know, but still, if a recovery is like an 80% rally or something like that, and you miss the first 20, it's like it's pretty meaningful, right? And then equity market return by the time GDP starts rising again. The 70s is really instructive. That middle 70s crisis. Right. So 50% market return before the economy starts growing again. And that gives you some sense of how anticipatory stocks really are.
So where are we? Where are we in terms of capitulation? Well, AI bearish sentiment is as high as it's been since the GFC. There's like everyone's bearish for good reason. This is an interesting one. Stocks trading underwater. We just spoke about Robinhood. This is as high as it's been in my lifetime.
Whoa, what is this? Percent of companies trading below cash and short-term investments. 12% of companies are trading below their cash? Mm-hmm. Can I throw one thing out?
Wait, but this makes sense.
Why this is the case?
This makes sense. Because a lot of companies were hemorrhaging money and were being subsidized by investors, and that's over.
But also, we had thousands of IPOs, and those are the types of companies that have a lot of cash. But
okay, come here.
We all want to see the after. That would be, but all these IPOs and SPACs, they had a lot of cash. So those would be those companies where the stock price has fallen below the amount of money that they were able to raise from the street.
Lastly, let's look at the percentage of stocks under the 200-day moving average. You don't know where this is going to bottom. Come here, but it looks like a washout.
I feel like this is I wouldn't say as good as it gets, but it's pretty damn good. Okay. In other words, like, what would you be waiting for? You need to see 10% of stocks above the 200-day, 5%. Like, if you're in this situation now, there he is. How we doing, big guy?
Cubs, you okay? Mm-hmm. What happened? What happened to your leg?
No.
All right, he's done. All right, he's fine.
What a cutie. All right. This will be a good story sometime.
Yeah.
All right. What are we doing next?
Howard Marks. So he's buying the dip.
Have you ever heard him this aggressive in print? It wasn't in print. I think he did a TV interview.
No, it was the FT.
Oh, they talked to the FT. All right. Financial Times, quote, "The time is right to snap up bargains in financial markets following a widespread sell-off," according to Howard Marks, one of the world's most formidable distressed debt investors. "Today, I am starting to behave aggressively," the founder and co-chair of Oak Tree Capital Management said. "Everything we deal in is significantly cheaper than it was 6 or 12 months ago." Yeah, no shit. He highlighted drops in the prices of high-yield bonds, leveraged loans, mortgage-backed securities, collateralized loan obligations. And let me just round off here. The main gauge used to measure junk U.S. corporate debt has registered a loss of just under 13% this year, which is the largest drop for the high-yield debt index since the financial crisis in 2008.
Oh, wow.
Yeah.
But you know what's interesting? But look at spreads. They're really not widening out. John, chart on. This doesn't look like a lot of distress. Now, compared to where prices were.
The stress is in the treasury market.
Compared to where prices were 12 months ago, yeah, things look like cigar butts.
Yes. So the stress is not just in junk bonds. The reason why those spreads aren't blowing out is because treasuries got nailed also. and yields have gone much higher, really across the board. Doesn't matter. Credit quality was not the issue. Duration always was. So, listen, here's the thing with marks. At a certain point over the last 5 or 6 years, I'm not going to say you were saying this, but people that we know who really love Howard Marks and read all his stuff had begun to say, okay, it's a broken record. We get it. Like, now is not the time to take risk. This is like as close to a buy, table pounding buy as anything I've ever read from him. Do you agree with that?
Yeah. No, it's good to say.
I wonder what he's buying. Do you think he's buying there's not a lot of distressed assets though, really? Like there are high yield bonds where yields have gone up, but there aren't like lists of potential bankruptcies, at least not yet. So what do you think he's buying?
Celsius and Voyager.
No, come on. In real life, what do you think he's buying?
I don't know. I have not thought about it. Don't know.
Okay. We gotta figure that out somehow.
Let's keep moving. Sorry, we're running late. All right. Dr. David Kelly and his team from JP Morgan. A lot of JP Morgan tonight. They did a mid-year outlook, and let's start with this. Look at the price return decomposition. So earnings have grown 6% year to date through the end of May.
That's so surprising, given how negative everything and everyone is. But it's true. It's real.
We know stocks are down lower than 13%. This is through the end of May, but it's all multiple compression, which is if there's anything that's healthy in this cyclically market, that's it, right?
Let's just help the viewers out with decomposition of returns, just for people that have never heard the term before. So the S&P 500 price return, like what you see when you look up how's the S&P doing this year, is down 13.5%. We arrive at that number by adding 6.2% earnings growth and then subtracting 19.5% on the price multiple that we're paying for those earnings. So even though corporate profits are up, prices are down so much that we have a negative year, which I suppose does happen. And it's one of the reasons why single variable analysis, like what's earnings growth going to be next year, is so unhelpful. Because here's a year with fairly average earnings growth, or maybe slightly sub-average earnings growth for this particular cycle, and stocks are down big. And so it's really tough to just look at one and think you could figure out the whole picture.
So this really surprised me. Look at international stocks. Year-over-year earnings per share growth was 35% in Europe, 11% in Japan, but not surprisingly, given the invasion and how reliant Europe is on Russian energy, their multiples got bushwhacked even harder than ours did.
Wait, Europe ex-UK has a massive multiple and currency detraction.
Yes. But look, they've had the strongest earnings growth, which I thought
they've had the best earnings growth, and they've had the worst hit on the multiple.
Because if you think we're bearish on like the U.S. economy or U.S. stocks, forget about it.
Right.
If there is a bear,
you know how afraid the average German is of inflation, like just from historical, with good reason. Like the last bout of really, really, really bad inflation turned the country into the Third Reich. They don't like this shit.
If I was to lean into the bear porn, I would throw up this margin chart to say that we haven't even begun to see margin compression. That profit margins have been abnormally high.
Some people said, Mike, how is this possible?
Because for the most part, they were able to push through prices to their buyers. Ben and I were talking about this today. But there is a tipping point. And we saw that in Walmart. We saw that in Target, where it's like, okay, we are a low-cost provider. There's only so much cost that we could pass on before we have to start absorbing it. So margins have peaked. And depending on how much they rolled, this will severely hit earnings and will severely hit the stock market.
I was listening to Chanos on with Joe and Tracy, and he was talking about how like where the rubber meets the road might be all the stock-based compensation that is not currently showing up for these companies. But then all of a sudden you start having people that say, you know what, actually, I don't want the equity, I want the cash. All of a sudden, those things become P&L line items, and it's not just going to be a one-way street forever. And then all of a sudden, people are going to just be shocked by that turnaround. I think there are a lot of things like that, some of which will affect profit margins and some of which will just be felt elsewhere on the income statement. But worth considering, I guess.
Last thing before I throw it back to you, this was an interesting statistic from the Kobeisi letter. I don't know how to pronounce it. I'm sorry. They tweeted the average bear market since
I believe
1980.
it said Kobe Bryant.
Right. The average bear market since 1980 has had 3 relief rallies of 10%. Interesting. No bear markets since the VIX was created has bottomed with the VIX under 45.
That's crazy. Really?
We have had 2 relief rallies of 10% or more, and the VIX has yet to even cross 40. A bet on a bottom now is a bet against history. I thought that was interesting.
How many bear markets are in this sample? 4?
Well, since okay, fine, but it's interesting because there is a difference between capitulation, which I think we've seen, and panic, and like a panic bottom, which we haven't. So there's a difference between like a slow grinding capitulation versus what people are looking for, I guess, is a capitulation on volume with a VIX spike, which we might not get. We just might not get it. All right, let's move on to your next topic.
Okay, I think we end here just with this is so classic. Wall Street overhired for the cycle. I understand why. You know how people were like, manufacturers were double ordering parts and stuff, like just to make sure they had enough inventory. I think Wall Street double ordered people. It's understandable. Some of the most profitable stuff the street does is underwriting. And the sheer amount of underwriting over the last 3 years has just been like a torrent. So now we're probably going to start reading stories about bonuses coming down, rescinded offers, and then what usually happens next is headcount reduction. So this is CNBC. Broad-based job cuts loom at major banks for the first time since 2019. The math is ominous. Headcount at JP Morgan's investment bank, Goldman Sachs, and Morgan Stanley jumped by 13, 17, and 26% respectively in the past 2 years amid a hiring binge. Meanwhile, capital markets revenue has fallen off a cliff. When banks have a revenue problem, they're left with one way to respond: ripping out costs. What are your thoughts?
I'm not surprised that they overhired and now it's more on the other side of that. There was a chart that I didn't throw up in here, but that looked at the IPO and SPAC boom over the past 10 quarters. And it went like this. And so a lot of excess headcount, I'm sure, for the underwriting department.
In February of 21, there were $3 billion worth of SPACs being priced per night. You have to overhire. Like when that's the environment, think about it. You're earning 10% investment banking, selling concessions or commissions or whatever on $3 billion a day worth of activity. You have to overhire. It's worth firing people later. You can't not have the staff to play in a bubble like that.
Yeah.
We don't get that many of them.
All right, listen. So. I'm going to hop before the questions because I want to go be with Kobe.
Do your thing.
Sorry for
Ice him down.
Sorry for the awkwardness, and thank you everybody who stuck with us. Duncan, get in here. Bye guys. Have a good night.
All right, let's do viewer topics. Duncan,
should we leave his window up or?
No, close his window. It's me and you now.
Yeah, I'm gonna kick him. Thanks everyone for sticking with us tonight. We have almost 1,300 people watching, so that's pretty impressive that we didn't lose a ton of people during that whole debacle. Just another reminder, please hit the subscribe button if you're not subscribed. There's a button, let's see, down here somewhere. Oh wow, that's really hard. But down in the corner, if you're not subscribed, please click that. We appreciate it.
Where is it?
It's down in the corner. If you're not subscribed, you see it.
No,
otherwise
it's not.
you don't see it.
Oh, I got you.
Yeah,
okay.
yeah.
All right, go ahead.
It's there. Okay, so first up tonight, we have a question from Alex in Frankfurt, Germany. And Alex asks, I have an account where I can still get margin loans in euros for only 1.5% per annum. The dividend yield for the Vanguard All World High Dividend Yield ETF currently sits at 3.9%. I was wondering if it is smart to buy such an ETF on margin. My current portfolio is unlevered, but I'm planning on buying on margin until the debt level reaches 30% of portfolio value.
I don't hate it.
Is this like a kind of arbitrage? Is that what this is? Or?
I don't hate it, but I want to say two things about how margin works in the United States, and I don't know if this is applicable to Europe or Germany in particular. First things first, margin rates change. And they change without warning. And sometimes they change in response to overall interest rates in the economy. And then sometimes they change based on volatility in the markets and the risk committee at the broker-dealer or the investment bank or wherever this guy's investing in Germany. They'll change because the risk committee is like, we have way too much, money on margin, way too many accounts that are levered X%. It's not like a touchy-feely thing at first. It's usually like an algorithm that they rely on to tell them what they need to do. But I bring that up because you might invest in, for example, the S&P 500 right now and use a margin loan that's at 1.5% interest. But if there's a hurricane in the markets, that 1.5% can quickly go to 4%. So the yield on the S&P 500 is like, let's say 1.8%. So like you're trying to capture some income on that portfolio, and then you could lose 6 years worth of that income on one bad day. So I typically don't love just an automatic leverage position in a stock portfolio just because the borrowing rate is cheap. The borrowing rate can change, conditions in the markets can change, and it's not generally something that I would tell people to do. But I don't hate it in this particular case, as long as like the viewer suggests, they're going to watch it closely and they're going to use some sort of a level at which things change. So I think he said 30% or whatever.
Right.
You could do it. I don't bless it, but I'm not mad at you either.
Yeah, they seem to have really thought it out, but yeah, it sounds a little scary with the.
Dude, I've seen margin rates go. I've seen margin rates on individual. I used to get a list in 08 and 09 in like a real crash. The margin clerk, I was like a co-branch manager. The margin clerk would come out to my desk, give me a list. The 50 most volatile ETFs and stocks were on the list, and it would list an individual margin rate for each security based on their own. And this was Fidelity. This was National Financial Services, which is Fidelity Clearing. And what are you going to do? Say no? So you would go overnight. You would have like an $80,000 margin call on a client account because they own securities where the rates were jacked up from 4% to 20%. No warning. They're there. It's everybody protects their own ass. So that'll happen again. And I think you should be aware of that. Okay, what else you got?
Scary. Yeah, and for those who want to hear more about that time in your life, they should go read Backstage Wall Street.
Go for it.
Yeah. Okay, so up next we have a question from Jeff. If layoffs start to pick up steam, wouldn't all the people who bought homes in 2020 and locked in the low rate on their mortgage still be in trouble and in a situation to sell their homes? There may not be a subprime crisis, but your low rate means nothing if you no longer have a job. Love to hear your thoughts.
Sweet. So this is about adjustable rate mortgages
They're kind of
or just
asking
the low
if
rates
the
in general?
housing market is still kind of in trouble, even if people have low rates. If we're about to have a bunch of people out of jobs if a recession happens.
Listen, I'm gonna tell you something. The housing market is always in trouble, but it's a local phenomenon. So in some places it'll be in trouble because people aren't keeping their jobs and banks stop making loans in those areas. And there's like something is going on specific to that area where either they overbuilt or a specific industry got in trouble, or they closed the old plant and shipped the jobs to Mexico or whatever. There's always going to be a housing market that's in trouble. Today we have housing markets that are quote unquote in crisis because there aren't enough houses. Like literally, that's what we have right now, a few months worth of inventory in some of the biggest markets in the country, areas in California, New York, Florida. So there are people living and working in the reality of that market who are calling it a housing crisis or an affordability crisis. What they mean when they say affordability crisis is the prices are too high, right? Like so the housing market, the rest of your life will always be in trouble. There will always be somebody that thinks the housing market is terrible. Right now, it's buyers, believe it or not. Talk to me a year from now. It might be the sellers. Oh, this market is terrible. It's always going to be something. I wouldn't let that affect how you choose to invest in the stock market. Just accept that there's always going to be some problem with. I don't even know what we're rooting for. What are we rooting for? America. What's like the best housing market? Up another 10%? Would that be great? For the 60% of families who own a home? Is that what we want? Or down 10% for the 71 million millennials who are trying to buy homes now after renting for 10 years? Like, what are we rooting for? I don't know. What's good, what's bad? So don't get caught up in that shit.
Right. Yeah. No. So the best we can do is just try to speculate on each market.
How's the housing market? I don't know. How old are you? Are you buying? Are you selling? Do you owe money? Do you have great credit? I'll tell you how the housing market is. You tell me what your story is, right? That it's like that.
Yeah, that makes sense. All right. Well, I think that's it.
Think we got it?
Yeah, I think that's it. I mean, we could do another.
Listen, I just think that the way that we got through this show and the way that we handled all of the various things that took place during is really a testament to my greatness as a broadcaster. Like, I don't know if that there's any better takeaway than that. Like, if you were to leave tonight with one thing, it should really be, holy shit, Josh is a pro. Right?
I would ask that you have your guitar next to you, so next time you could play music.
I feel like you're not taking me seriously. All right, listen up. It's Tuesday night. That means new Animal Spirits podcast and video tomorrow. Look for that. The end of the week, another new The Compound and Friends. For the latest in financial blogger fashion, please check out idon'tshop.com. All of your favorite Compound merch is there. Duncan, thanks for all your help tonight. There was very little you and I could do, but I think we did okay overall. Guys, thanks for sticking with us. Michael's son is okay. No problems. We'll see you next week.
See you, everyone.